This question tests the impact of changing the inventory costing method from FIFO to LIFO during a period of rising prices, inflation. Students should understand how inventory valuation affects both the current ratio and the inventory turnover ratio. Under FIFO, first in, first out, the oldest and lower cost inventory is expensed first, leaving the newest and higher cost inventory in ending inventory. During inflation, FIFO results in higher ending inventory values and lower cost of goods sold, COGS. Under LIFO, last in, first out, the newest and higher cost inventory is expensed first. As a result, COGS increases and ending inventory decreases during inflation. The two ratios are: current ratio equals current assets divided by current liabilities, inventory turnover equals cost of goods sold divided by average inventory. Because LIFO reports lower ending inventory, total current assets decline, causing the current ratio to decrease. At the same time, COGS increases while average inventory decreases, both of which increase the inventory turnover ratio. A. Both the current ratio and the inventory turnover ratio would increase. Incorrect. The current ratio decreases under LIFO in an inflationary environment. B. The current ratio would increase but the inventory turnover ratio would decrease. Incorrect. This is the opposite of the expected effect. C. The current ratio would decrease but the inventory turnover ratio would increase. Correct. Lower inventory reduces current assets and the current ratio, while higher COGS and lower inventory increase inventory turnover. D. Both the current ratio and the inventory turnover ratio would decrease. Incorrect. Although the current ratio falls, inventory turnover rises. Correct answer, C. The current ratio would decrease but the inventory turnover ratio would increase. Key takeaway: during inflation, switching from FIFO to LIFO lowers ending inventory and current assets, reducing the current ratio, while higher COGS and lower average inventory increase the inventory turnover ratio, indicating faster inventory movement. This question tests the financial statement effects of a share repurchase, treasury stock purchase. When a company buys back its own common shares using cash, the transaction affects the balance sheet by reducing cash, an asset, and shareholders' equity, through treasury stock. However, it does not affect the company's revenues, expenses, or net income because it is a financing transaction rather than an operating transaction. Students should evaluate how this transaction influences key financial ratios. Debt-to-equity ratio equals total debt divided by shareholders' equity. Since equity decreases while debt remains unchanged, the ratio increases. Earnings per share, EPS, equals net income divided by weighted average shares outstanding. Repurchasing shares reduces the number of outstanding shares, so EPS generally increases if net income remains constant. Current ratio equals current assets divided by current liabilities. Cash, a current asset, decreases while current liabilities remain unchanged, causing the current ratio to decline. Net profit margin equals net income divided by net sales. Because neither net income nor sales changes, the net profit margin remains unaffected. Thus, the financing transaction changes balance sheet and per share measures but does not affect profitability ratios based on income and sales. A. Debt-to-equity ratio. Incorrect. Equity decreases, so the debt-to-equity ratio changes, increases. B. Earnings per share. Incorrect. Fewer shares outstanding generally increase EPS. C. Net profit margin. Correct. Net income and sales are unchanged, so the net profit margin is unaffected. D. Current ratio. Incorrect. Cash decreases, reducing current assets and lowering the current ratio. Correct answer, C. Net profit margin. Key takeaway: a share repurchase is a financing activity that reduces cash and shareholders' equity and usually increases EPS while affecting leverage and liquidity ratios. However, it does not change net income or sales, so the net profit margin remains unchanged. This question tests the relationship among operating income margin, operating asset turnover, and return on operating assets, ROA, using the DuPont framework. The key formulas are: operating income margin equals operating income divided by sales, operating asset turnover equals sales divided by average operating assets, return on operating assets, ROA, equals operating income divided by average operating assets. ROA can also be expressed as ROA equals operating income margin times operating asset turnover. The company increases its investment in operating assets, financed by debt. The phrase "assuming all other factors remain constant" implies that sales and operating income remain unchanged immediately after the investment. Therefore, operating income margin remains unchanged because both operating income and sales are unchanged. operating asset turnover decreases because the denominator, operating assets, increases while sales stay the same. Since ROA equals margin times turnover, ROA also decreases. The financing source, debt, does not affect these operating performance measures directly because they focus on operating activities rather than capital structure.
A. Increase, no change, increase. Incorrect.
Neither operating margin nor ROA increases when operating assets increase without additional sales.
B. No change, decrease, decrease.
Correct. Operating margin stays constant, while higher operating assets reduce asset turnover and consequently reduce ROA.
C. No change, increase, decrease. Incorrect.
Asset turnover cannot increase when operating assets increase and sales remain constant.
D. Decrease, decrease, decrease. Incorrect.
Operating income margin does not change because operating income and sales are unchanged.
Correct answer, B. No change, decrease, decrease.
Key takeaway: increasing operating assets without increasing sales or operating income lowers operating asset turnover and return on operating assets, while operating income margin remains unchanged because profitability relative to sales has not changed. This question tests the accounting and financial ratio effects of a stock dividend. A stock dividend distributes additional shares of common stock to existing shareholders instead of paying cash. Because no cash or other assets leave the company, total assets, total liabilities, and total shareholders' equity remain unchanged. The transaction simply reallocates amounts within shareholders' equity by transferring retained earnings to common stock and additional paid-in capital. Students should recognize that a 50% stock dividend increases the number of common shares outstanding while leaving the total book value of equity unchanged. As a result, the book value per common share decreases because the same total equity is spread over a larger number of shares. The stock dividend does not affect liquidity or operating performance, since no assets are distributed and no operating income changes. Therefore, ratios based on assets, liabilities, or operating income generally remain unchanged.
A. Current ratio. Incorrect.
A stock dividend does not affect current assets or current liabilities, so the current ratio remains unchanged.
B. Book value per common share.
Correct. The number of common shares outstanding increases by 50%, while total common equity remains the same. Consequently, book value per share decreases. C. Debt-to-equity ratio.
Incorrect.
Total debt and total equity are unchanged, so the debt-to-equity ratio is unaffected.
D. Return on operating assets. Incorrect.
A stock dividend does not affect operating income or operating assets, so this profitability ratio remains unchanged. Correct answer, B. Book value per common share. Key takeaway: a stock dividend increases the number of shares outstanding without changing total shareholders' equity. As a result, book value per common share declines, while liquidity, leverage, and operating performance ratios generally remain unaffected because no assets or liabilities change.